Consumers are showing in our monthly surveys that they're getting less and less confident in the economy as the year wears on. And there's several factors that are driving that. One is the job outlook. The biggest reason, though, however, is inflation and the continued pressure on essential categories like food, housing, even debt now is sort of emerging as a topic for consumers. And so they are trying to muscle through this environment as best as they can. And that is weighing on the retail sector, and it's weighing a little bit on the holiday season as well.
But we're seeing some pretty good numbers out of some of the retailers. I mean, I'm seeing, probably 3-4% retail sales growth here in the holiday season, with the e-commerce even higher than that. It seems like consumers are still spending, though.
They are, Paul, and they are trying to spend on the holiday and kind of keep that basket together as best as they can. But there's some underlying factors that make the headline data a little bit more nuanced. So the majority of what we're seeing is that those year-over-year gains are driven primarily by price actions and not volume. And in fact, in our headline outlook for the holiday season, we sort of forecasted about a 2 to 3% year-over-year growth rate. I think it's coming a little bit higher, which is good news, but the majority of that is driven by price. Almost 2/3 of that is driven by price and not volume. So, as a retail sector, you'd like to see more volume going out the door historically. And so, again, it's a little bit softer. I think part of that is certain chains have really resonated with consumers this holiday season. They've gotten the value equation better aligned to expectations. And there is some channel switching happening that appears in our survey as well. And we're seeing that increase as consumers want to sort of shop what they've always shopped for, but get a better price for it in whatever channel is best suited for them.
Yeah, we were talking about somebody earlier, talking about shopping earlier in the show and how consumers have become much more intentional about what it is they're spending their money on. But let's talk about restaurants and bars and how we're spending on that. I mean, did you talk about that in the survey, and what did you guys find out?
We do, and that sector in particular is getting is facing much more significant headwinds because it's the first category consumers repeatedly tell us they're going to pull back on, and indeed we're seeing that in some of the top line numbers. Albeit there are a couple really exciting sort of turnaround stories in the sector that I think shows that point about aligning with consumers. But in general, consumers, the number one category they want to pull back on is eating out, particularly at higher end establishments. And so when they're paying more for groceries and the basics, it kind of makes sense that they would switch to more in-home eating. And so that really is putting a pressure on restaurants. In the QSR space, you're seeing a lot of revamped emphasis on value and value menus to try and stem that tide. But it has been a tough year for the restaurant sector in general, and we don't expect that to change much going into 2026.
Will, what's typically an antidote to consumer spending concerns? I'm not sure it's the Fed cutting interest rates by 25 or 50 basis points. And it seems like the economy is essentially fully employed. What needs to change here?
Yeah, I think it's a couple things. One is that they have to have more confidence. And, with all the change in the policies coming out of the federal government, with concerns about inflation really showing up in their, the receipts, and some concerns about the economic outlook and a little bit of AI. It's sort of a psychological aspect to this that's really weighing on the sector. However, there are some real economic drivers because a lot of the GDP growth we're seeing is driven by what we call the 3 A's. So that's affluent consumers, that's asset price realization in the stock market, and I'm forgetting the third A. It's AI-driven investment, which is fueling the sort of the stock price appreciation. So that's propping up a lot of this, and affluent consumers in particular are really need to kind of continue that spending pattern as we go into 2026 if we're going to continue at the levels we're seeing today.
And with in terms of how we're paying for these things, and consumers taking on debt, especially during the holiday season, I know that they're using a lot more buy now, pay later platforms, and that could be troubling down the road.
Yeah, that is a concern for us to monitor. And savings in general has declined since Liberation Day. Again, as consumers try and buy what they've always purchased, but in the face of higher prices. So we've gone from a savings economy to a debtor economy, and that shows up in the macro data. that is a potential risk in the outlook for 2026, because the question is how long can they keep doing that? And those debt levels have sort of increased generally across all income segments as well. So it's not just centered in one income segment. We're not reaching sort of crisis levels by any stretch, but it is another potential headwind as we cross into next year.